The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Good morning, everybody. I hope you had a wonderful weekend. Juliana, did you have a lovely weekend?
Morning. It was pretty good.
Oh, very good, apart from me messaging you about various things. Happy Monday, everybody. Welcome to Squawk Box with Juliana Tattlebaum. It does say I am her, but I am not. I'm Steve Sedgwick, and these are your headlines. So, the Senate advances a bill to end the US government shutdown and fund federal agencies through to January. Not that long, is it, really? Anyway, through to the end of January, with the measure potentially heading to the House, to the President, within days. Global equities gains on signs the deadlock could be ending, with futures in the US and Europe pointing higher. The Nasdaq looking to rebound from its worst week since April.
Novo Nordisk loses the bidding war for Metsera as Pfizer closes a $10 billion deal for the U.S. biotech company. The Danish pharma giant says it will assess other takeover options as it scrambles to regain its competitive edge in obesity drugs.
I am one of the less understanding people in the market. I was going to call myself thick, but I do not understand so much about the market. And I've been around for 1,000 years. One thing I don't understand is when there is a shutdown, the longest shutdown ever. Good morning, you lot. I've done that, haven't I? Okay. When there's a shutdown and the market rallies to record levels on the back of not worrying about the shutdown, that's fine. Market's ignoring it, saying it doesn't matter. When there's no shutdown, the market still rallies aggressively as well. So why did my headline say this morning that we're rallying on signs the shutdown could end when the market rallied aggressively anyway, not worrying about the shutdown? It didn't sell off last week because of the shutdown. It sold off last week because of AI valuation concern. That's what I understand. I am that person. I don't get it.
Well, I think like many times this year, there's been the fear that the market would sell off on various things, including the shutdown. It hasn't really happened. I think over the weekend, there was major fear that we could see the shutdown run through Thanksgiving, and that could be hugely disruptive from a travel perspective and then in turn an economic perspective. So it does feel like there's a lot of relief running through investors' psyche right now, but whether we would have seen continued gains anyway, I think you make a fair point.
Is that all it took? 2,700 flights cancelled and 10,000 delays at US airports? It's Thanksgiving. We need to travel. And that's all it took. Amazing. Anyway, the US Senate has voted to pass the first stage, only the first stage, of a deal which would see an end to the country's longest ever government shutdown. Now, it's the rank and file. This is really important. Rank and file Democrats, 8 of them, joined all but one Republican in favor meeting the 60 threshold needed for the procedural measure to pass. The agreement would fund the government until the end of January and includes a guarantee by Republicans of a vote on extending Enhanced Affordable Care Act tax credits in December, okay? A vote, not extending them, but a vote on extending them. That is also very important. The deal also calls for the reversal of all permanent layoffs of government employees during the shutdown. Let's move on to the markets as well, because I think it's very interesting looking. Actually, we talked about the worst week for the Nasdaq last week, but it had a stonking great rally off its lows on Friday.
Yeah, it did. It was a volatile week. I mean, ultimately, the Nasdaq did end about 3% lower for the week overall, but it was a mixed session on Friday, and we had moments of stability, moments of rebound throughout the week. Nevertheless, we did have a pullback over the course of the week. The S&P ended about 1.6% lower for the week, the Dow 1.2%, and the Nasdaq, as I said, off 3% for the week. Those are Friday's moves for you. So fairly stable session on Friday relative to some of the stronger moves we'd seen earlier in the week. As for Asian markets in the more recent trade, we are seeing strong gains in the region. The Kospi leading the charge up about 3% in the session. The Nikkei 225 also charging higher by about 1.3%. The Hang Seng also participating in the rally up 1.5%, and a little bit more muted, but gains nevertheless in the Shanghai Composite in mainland China. Let's take a look at European futures now. What the early indication is for the European Open. We're looking at strong gains there as well. At this early hour, we're looking at a more than 1% bounce in the CAC, the DAX, and the FTSE MIB. FTSE 100 looking to lag slightly, but still gain about 0.8% at the open. And again, for context, last week, the stock 600 pulled back about 1.2%. So a little bit more resilient than we saw for the tech-heavy NASDAQ, but ultimately European equities did sell off in sympathy with the U.S. Finally, in terms of U.S. futures, here's your early look. We've got gains for the NASDAQ, pretty sizable ones at that. The NASDAQ looking to bounce about 300 plus points at the open. The Dow, the S&P 500 also looking at stronger starts this morning. Well, we've got a great guest for you to kick things off this morning. That's Nick Nelson, Global Equity Strategist at Absolute Strategy Research. Nick, it's always great to have you with us. Let's kick off with your take on the news around the U.S. government shutdown. It looked like we could potentially be heading for a really disappointing travel season in the U.S., but now looks like we're going to avoid that, and we've got a better scenario on our hands. How impactful is that from a market perspective?
Yeah, look, I think it's important because we could see, as you were just saying, we're selling off last week. There's other issues, there's AI and other things out there. But I think government shutdown, the longest in history, and as you say, coming up to Thanksgiving, we were going to have, I think, about 10% of all US flights cancelled. And obviously that has a knock-on effect on travel, leisure, confidence. And then you have all the furloughed workers who are not getting paid. So the longer it goes on for, of course, the more people worry about the impact on the economy. So good news and market futures up this morning.
We're seeing market futures, sharply higher. The NASDAQ looking to regain 300 plus points. And the tech trade has been really front and center over the last week. Huge volatility last week. What do you make of the moves we've seen, and what's actually driving the market right now?
Yeah, so look, it's had an incredible run this year. And I think that we're struggling with trying to get our arms around some pretty big concepts here, like how powerful is AI going to be in terms of what returns people are getting on this capex, and it's not just been the stock market, it's been the broader economy. So if you look at the first half of this year, half of the economic growth was basically coming from AI capex, the other half was coming from consumption. So this is driving not just the NASDAQ, not just corporate profits, it's also driving GDP.
Let's just go back to my initial bemusement. And as you know, Nick, you've known me for about 20 years. You know I'm always bemused. Market did not factor in when it was having all its other reasons to rally. The fact there was a few flights cancelled and Americans couldn't get around to Thanksgiving. I know it's a massive issue, but the market wasn't thinking about that at all on Friday or even at all last week as well. So why should it matter to the market about the shutdown when it didn't matter when it went to record levels?
Interesting. I think what was started, we saw that very weak consumer confidence number coming out at the end of last week. So I think maybe people are trying to add those together. There's obviously the fact that just the longer it goes on for people not getting paid, whether that has an effect on consumption. But I agree with you. I think the more important issue is AI. The more important issue is the valuations around these stocks and how they're reacting to the capex spend. I mean, I thought it was really interesting 2 weeks ago when we had Meta announce down 13% on the day. 24 hours later, Amazon announced up 13% on the day, right? Wow. So it feels like the market is starting to try and differentiate between good AI capex and bad AI capex.
Well, that's always the best bit, to be fair for me, because I get to see who's the winners and losers rather than just everything being floated. But that's a great point. But can I add that to the brilliant performance of the retail investor in 2025? When we're looking at who the heroes and zeros were, they won in April. They nailed it, the retail investor, by buying the dip. Buying the dip has been a brilliant strategy for them this year, unambiguously, but it can be very fraught. Are we going to see buying the dip this week?
Well, I think we probably will. The big news is probably not this week, it's next week. Right, next Wednesday we're getting NVIDIA to complete the set of the Mag 7, as it were. And I think there, of course, there will be a huge amount of focus what they give us on the outlook, what they tell us on demand, compute demand, all those kind of factors. But that, for me, would almost be more important than the government shutdown news as we work through that through this week and beyond.
Nick, let me come back to your point about the market beginning to differentiate among different AI capex spenders, because Friday we had a really interesting story here in the UK with Rightmove. And I know you're not a single stock guy, but Rightmove, the stock plunged 25% at the open because they said they're going to be investing in AI over the next few years, and they put out some disappointing profit guidance as a result. How can investors gauge when investors are going to like announcements like that and when they're going to hate it? Because it seems like it's becoming sort of dangerous territory. It's no longer the case that if you say AI is central to our strategy, you're going to get a big boom in your stock price. Yeah,
look, and I think that's the case. And taking a step back and looking at Meta from the week back, you saw that corporate bond, $25 billion corporate bond. These companies used to be very net cash, and now they're moving into debt. They're doing a lot of issuance. And of course, shareholders they like dividends, they like share buybacks. And then if you're doing this capex, they do want to see the returns. And I think it's, if you suggest you're not going to see the returns in the near future and you're doing the heavy capex, then that is when alarm bells start ringing. And that's when I think you see companies, share prices come down on those effects.
I think the alarm bell should be ringing way earlier than that, and that is the debt accumulation. No one seems to be looking at that side until they do and say, well, have you not seen this? It's enormous as well. And it's almost like it's been giving a pass on the debt accumulation because we're assuming that it will be profitable growth on the back of that debt being raised. It's not. And you've already just said there's going to be wheat and chaff. Yeah. So should I be worried about the trillions of dollars of debt accumulation? Because it's always the corporate bond market. No, that's not true. It's mostly the corporate bond market that is the canary in the coal mine.
Yeah, but the starting point for this sector, remember, was net cash. If you go back a decade, they had $200 billion of net cash, the tech sector, US tech sector as a whole. It's now got $200 billion of net debt, which in aggregate is not much, right? You look at NVIDIA's market cap of close to 5 trillion. So I think for the time being, you can actually keep doing this capex. They generated $800 billion of cash flow in the last 12 months. But as you're going forward, the companies that are more levered and are struggling to raise that, then you start seeing stress in corporate bonds.
Let me follow up on that. Does it matter that some of the biggest debt accumulation is in the private sector, not in the public sector? And there are notable names there, including OpenAI.
Yes. Now that is an unlisted company. We don't have details on its numbers. We don't have details on its balance sheet, its P&L, as it were. And then you have, of course, the private credit sector, which have been, raising a lot of capital. So the leverage seems to be moved from, the banks, which was obviously before the GFC, all the leverage was in the banks. Now it's in the corporate bond market. Now it's in private equity. It's in private credit. It's in hedge funds. It's insurance. So, we've written a lot at Absolute Strategy on these non-bank financial institutions, and they're the ones where the problems are likely to come up rather than the banks.
Let me ask you about the U.S. consumer. You mentioned briefly the data we got at the end of last week, the confidence data, University of Michigan survey, pretty disappointing. Yeah. And it adds to a string of data that has suggested maybe the U.S. consumer is weakening more than we thought. When you put it all together, what do you think about the health of the U.S. consumer?
So I think we've still got a reasonably supportive labour market. Of course, we don't know because we've not been seeing all the data because of the government shutdown, which makes it trickier. But we do have, as people have referred to, this K-shaped economy, so that the wealthy incomes with the close to record high stock markets. So
John Williams has been talking about that this weekend, and he's quite concerned about it.
Yeah, and because I think the poorer incomes or lower income households are struggling, right? Because they don't have that asset growth to support them. They've maybe not getting the same wage growth that's coming through. But in aggregate, we still have a relatively stable market. We have a relatively low unemployment rate. And we have this, this capex boom that's driving the economy at a headline level.
I'm not saying there is going to be a correction. I don't have a clue, to be honest. But if there is one, where's the safest port in the storm?
Well, I think it would be the sectors that hadn't run. So it'd be things like healthcare.
So it's still in equities?
Within the equity market. I mean, otherwise it's cash. It's short-dated government bonds. It's highly rated corporate bonds. That's where to go outside of equities. But in equities, it would be the consumer staples, but probably more actually healthcare.
Well, consumer staples, that has been a bit of a dog of a sector. And you look at the earnings growth. I mean, they've been struggling before this year, but now continue to struggle. And the share prices have also struggled, as the companies have. You think that could be a safe place to hide out right now?
Well, we've been underweight because we've been overweight tech and banks. But to Steve's point, as if you were going to get the correction, I think it would be some of the parts of the market that hadn't run, some of the markets in the market that were less economic sensitive. But you're right, it's not been a great sector. It's not been delivering on earnings. The sectors that have been outperforming, it's been very simple, have been the ones delivering on earnings. Tech's printing 30% earnings growth in this quarter. Financials are printing 25% earnings growth year on year. Those are the sectors that are doing quite well.
Tell me about financials, just very briefly, because it has been a re-rated sector on both sides of the Atlantic. You and I have had so many conversations over the years about underwhelming price-to-book values of European banks. That ain't the case anymore. We're still at a discount, but they've gone gangbusters. What do you think of financials?
So we're overweight banks, both the US and Europe. European banks, actually, on an aggregate level that we look at, we're just above 1 times price to book for the first time in about 15 years. So, that's an achievement.
Yes.
And yes, they have been re-rated, but they've been rated because they've been delivering on profits. They've had the best earnings revisions of any of the European sectors. And if you look at the US, you have this hopes of deregulation. You have this hopes of asset price and inflation that's supporting, and investment banking coming back, IPOs, M&A, which will help the market-driven parts of the banks. So I think both in the US and in Europe would stay overweight banks.
And when you talk about growth and how that's really been central to the names that have done well, that the tech giants are printing double-digit growth here. Outside of tech, if you don't want to play those sectors, where do you see the most attractive structural growth?
Yeah, so I mean, it's not been quite as narrow as maybe some people think. So in these Q3s, you've basically had 10 of the 11 sectors give you earnings growth. Energy is the only one that hasn't. Financials, as mentioned, has been the second best. Industrials are printing about 20% as well. I think some of the longer term themes for us would be around defense spend, which we've been bullish on for 3 years now, both in Europe but also in the US. I think industrials, because we think we need more capex. And in the sort of the energy transition play, energy security, water security, and food security. So stocks that can play on those investment themes, I think, are the structural growers outside of the AI and tech theme.
Did you go to the rugby?
No, I missed last day.
What do you mean you wouldn't?
I'm going on Saturday, though. You'll be pleased.
Who are they
to
playing on Saturday?
New Zealand.
Oh, is it New Zealand? Oh, wow, it's the big one.
Yeah.
That's exciting. Apparently, the biggest game of the weekend was France-South Africa.
That was amazing.
Yeah, I didn't see it. I was out. But, yeah. Anyway, you go to the rugby. Oh, the USA. Should I say how they got on? They lost 43-30 to Georgia.
Oh, Georgia.
No, not the the state.
This isn't a domestic game.
Nick Nelson, lovely to see you, sir. Thank you very much indeed for joining us. Nick Nelson, who is the global equity strategist at Absolute Strategy Research. What's coming up?
Well, we've got U.S. senators taking steps toward ending the longest U.S. government shutdown in history. We're going to bring you the latest. Plus, China will resume exports of Nexperia chips following a row with the Dutch government. And Novo Nordisk and Pfizer's bidding war for biotech Metsera ends, with the Danish pharma giant losing out. Charlotte will bring us the latest. Welcome back to the program. We've got some significant corporate news for you. Change at the top of Diageo. We've got news of new CEO. Dave Lewis has been named as the new CEO of Diageo. The appointment is going to be effective from January 1st. And a little bit of background, you may be familiar with the name because Dave Lewis was the CEO of Tesco from 2014 to 2020, so long run there. And he is currently chair of the consumer healthcare group Haleon. So a lot of experience in the UK in particular as he comes to take the helm of Diageo. And of course, there had been an interim CEO in place, Nick Jangiani, and he's going to continue as interim CEO until the end of December, until Dave Lewis takes over.
Look, a little bit of backstory here. The man who was responsible for the enormous growth over a longer term and turning Diageo into the world's largest, most important premium drinks business, bigger than Pernod Ricard, was Paul Walsh. And Paul Walsh was a brilliant CEO over at Diageo, if I may say that as well. Then he handed over the reins to Ivan Menezes, who was also did a fantastic job. I mean, no doubt about it. And I dearly miss Ivan Menezes. Unfortunately, he passed away in 2023. He was absolutely wonderful. It was unexpected, his death, and we all still mourn the loss of Ivan Menezes. Deborah Crew came in, and it wasn't the fact that Deborah was getting it wrong so much, it's that I would say also that macro and global conditions changed as well. And clearly there was investor disquiet at what was a very tortuous performance of the shares over the last couple of years when Deborah was in charge as well. And then when Deborah lost her job as well, the elongated search for CEO made things even worse. And so when you look at the share price, it has been a really horrible run over the past 12 months or so. It's a stock that, I mean, you can see there on the screen there as well. And I'm trying to look at the numbers, 25% lower. But what my point is, and I made this point, that it is a global downturn. In fact, do you know what I'm going to do? I'm actually going to bring Charlotte in here because I know that she doesn't necessarily prepared for this. You're not, but you have covered a lot the global downturn in luxury. And I do want you to go, and also you know Pernod Ricard very, very well as well. And I know you weren't prepared for this, so by all means don't worry about it too much. But I think it's very interesting that some of the luxury names have turned now but the luxury drinks makers haven't turned yet. And I just think that's very interesting. I don't know if you want to come in on that.
Yeah, we know the drink makers really push into the premiumization of drinks. That was this big area. I'd always thought, the cocktail making during
all
COVID.
The time from the
for years they've been talking about that.
And sadly mourned Ivan as well. He talked about premiumization all the time as well. So that strategy isn't working at the moment?
Well, it looks like it hasn't worked. Certainly when people felt the squeeze over the past couple of years, they moved away from that. And there certainly has been a movement that we saw recently. And in the US, the question of tariffs, adding a layer of complication with them and adding some money. For a long time, a lot of drink makers thought if people want a nice drink, a nice champagne, a nice whatever, they won't mind spending a little bit more for the brand that they want. Looks like that hasn't been the case.
No, you are so right. So if there was a sector that was lagging behind luxury, but maybe you guys want to look at, because I don't tell you what to buy, I don't tell you what to sell, but I just took a look at the price to earnings ratio of a stock like Diageo, which has enormous problems, but it has an enormously big and amazing portfolio. It only trades at 13.4 times forward as well. Again, I don't tell you guys to buy or sell anything. I'm just saying have a look at the sector and its value compared with other sectors and how it's performed as well. Charlotte, thank you very much indeed for that. I knew you respond with aplomb. I wonder what the French say for aplomb. Our next guest says there are dark clouds accumulating over the global economy as governments around the world raise trade barriers. Philippe Aghion is a professor at the Collège de France at INSEAD in France and has been recently awarded the 2025 Nobel Prize in Economic Sciences. And as you know, Charlotte is also on set. Philippe Aghion, sir, thank you very much indeed for joining us today. And by the way, first of all, congratulations. I mean, it is a packed field. Winning the Nobel Prize for Economic Sciences is phenomenal. Incredible, sir, as well. Tell us a little bit about where we're at in the world at the moment.
Well, the world is strange. You have the AI revolution, which I think is a great revolution with huge potential, of course, huge dangers as well. But I believe that AI has enormous growth potential because it automates tasks, not only in the production of goods and services, also in the production of ideas. It's easier to get ideas with AI. So it has big potential, but we need to adapt our institutions to harness the power of of AI. You see, to make it growth enhancing and also to make sure it will create more new jobs than it will destroy jobs. So this is, I think, a very interesting development. But on the other hand, of course, you have like dark clouds, of protectionism and populism. And so you have these two forces, you see what I mean? And my hope is that we limit the negative effects of populism here and there and harness as well as we can the power of AI.
Philippe, I hear you. And look, I am genuinely excited about AI. And I personally have started using it for my productivity in, for instance, my personal finances or my tax and what have you, which meant I didn't use an accountant, Philippe, which means that lots of other low-level jobs are disappearing. I know this because I'm seeing the evidence coming from one of the key HR bodies in the United Kingdom. I'm seeing it over at Amazon. I'm seeing it over at some of the financial institutions as well. Philippe, those jobs are disappearing as forecast. Productivity is improving as forecast. But where are the jobs being created across the board?
Yeah, so my view is that it's true. You have a substitution effect. There are a number of tasks and jobs that can be now performed with AI, and you don't need as many, as many employees as you used to. I mean, so that's on the one hand the substitution effect, but there is a counteracting productivity effect. When you adopt AI, you become more productive and therefore more competitive, and therefore the world market demand for your product increases, and that makes you hire more. So you have these two counteracting effects. In fact, if you look so far at French firms or Danish firms that adopted AI, they overall create, increase employment. Alors, it's true, not uniformly. There are some jobs they destroy and some jobs they create. Also, it's not uniform. The young are particularly affected by the AI revolution. The elder, less so. So it depends which use of AI, which type of occupation, young, old, employees. And so and there will be new jobs created. So I think it's true, some jobs will disappear, but I believe that there will be new jobs created. And the whole thing is to have a good labor market system that, makes the transition smooth as possible. You see, like in Denmark, when you lose your job in Denmark, you get 90% of your salary, and the state retrains you and helps you find a new job. I think we need to have this kind of labor market system in place to smooth out, the transition from old jobs to new jobs.
Professor, you've said if the American economy is powerful, it's because it is the most innovative. So I want to ask you, where does that leave Europe? We've heard a lot of European leaders talk about strategic autonomy, including President Macron. They've put some measures in place. Where does that position Europe overall and their economy in the current race?
Behind the US when it comes to, breakthrough high-tech innovations, okay? And now we are even lagging behind China in some areas. And that's a big concern, and that's what motivated the Draghi report. Draghi, had a very good diagnosis. Why is it that we are lagging behind? Europe was catching up with the US between 1945 and the mid-80s. And since the mid-80s, we've been lagging behind. And that's because we don't have a good ecosystem for frontier innovation. We don't have a single market in Europe. Each European country has its own regulations to European regulations. We don't have proper financial ecosystem of innovation. Not enough venture capital, not enough institutional investors, pension funds, mutual funds. Those are crucial to finance breakthrough innovation. And we don't have the equivalent of the DARPA, the Defense Advanced Research Project Agency, or the BARDA. Those are ways to do industrial policy in key fields like, defense, health, energy transition, which is pro-competition. So this is a modern way to do industrial policy, which the US have put in place. And in Europe, we don't know how to reconcile competition policy and industrial policy. So you see what I mean? We are very much lagging. We don't have the institutions and, that would favor breakthrough high-tech innovation.
And within Europe, if we can zoom on France in particular, there's been a lot of political turmoil. Things seem to have calmed down a little bit, but we are on the ongoing negotiations around the budget. Within this, we've heard a lot of talks around taxes in particular, tax on the wealthiest. They've voted the extension of the exceptional surcharge on large companies, on multinationals. So I want to ask you, where does that leave innovation potentially in France, given the new taxes potentially are being negotiated around the budget?
I've been fighting a lot against the Zuckman tax. The Zuckman, it's a colleague of mine. It's a very nice colleague and a very good economist, Gabriel Zuckman. But you see, he was pushing for a tax, that would include, the valuation of innovating firms. So, for example, we have Mistral is a very promising young company, a startup, in AI. It's highly valued at 12 billion euros, but it generates no cash for the moment. Well, had you implemented the Zuckman tax, Mistral would have to look for financiers to just pay its tax on a valuation which is volatile and uncertain, on a value which has not been generated yet. It's just on prospective future profits. So I fought a lot against this tax, and fortunately, they did not adopt that tax. And you're absolutely right. The big danger, I am in favor of redistribution, but France is already highly redistributive. And if you tax, capital, and if you tax productive investments, then of course you hinder innovation. You deter innovative activities. So I'm already happy that the Zuckman tax was not adopted, and I will be vigilant that they don't take steps that would really further discourage innovation in France.
Right. Philippe, you mentioned that there's not enough VC interest, VC funding in Europe, and we've heard that about the UK as well. How do you advise going about incentivizing more VC investment to get that funding for early stage companies, which obviously then pave the way for creating and building on this ecosystem you're talking about?
Yeah, so I think VCs, you have to create a system, I think to make it attractive for VCs, but VCs will come in if the other things, if for example we have a true single market, if you make if you have a business climate which is friendly to innovation, I think VCs will come in. You see, you'll become more attractive and VCs will come in. So I think the fact that we'll have more VCs or more business angels will naturally result from having in general a more, a business climate more conducive of innovation. One thing we can push a lot, and that's what Sweden has done, is to push for more institutional investment, despite the fact that they don't have a fully funded retirement system in Sweden. And the way they did it is that 2.5% of tax revenues in Sweden is automatically allocated to a pension fund. And people can choose the type of investment they want to make there. So I think that contributed a lot to Sweden being at the forefront of having a good financial ecosystem for innovation. So I think other countries should emulate the Swedish example and implement these kind of policies that would favor venture capital and institutional investment. So I think that's what I would recommend.